think this is the first time I've spoken in front of so many people. Everybody okay to hear me right at the end? Okay. Not asleep? Okay. Actually, each of us have about up to 10 minutes to speak, to sort of set the tone for this discussion. I myself have only about 6 slides, which I'll go through quite quickly, after which I will hand it over to Lorraine. The title says Beyond Market Volatility, Lessons Learned and New Opportunities. And then the subtitle, really some food for thought for all of us. And these are just generally macro observations from our side, as in KSC Capital. Okay. The first slide, really, a lot of people are talking about recovery. We are on the road to recovery right now. But this chart really shows that as far as the global recovery is concerned, at past experiences, whenever recessions are caused by financial sector getting into trouble, it generally takes longer. Okay, if you look at whether it's output, unemployment rate, nominal interest rates will stay low for longer periods of time. The GDP growth coming out of recessions that are caused by financial sector crises tend to be below that of normal recessions. Is it different this time? The market is running way ahead right now. Is the market right? I don't know, but the experiences are such that recessions caused by financial sector tend to take a little bit longer to recover. The second slide, we continue to have very mixed economic data all over the world. There certainly is there is data that shows that there's V-shaped recovery. An example would be the Institute of Supply Management data coming out of the United States, which is on your right-hand side, the chart. You can see clearly a V, but consumers are not spending. Or consumer spending in the United States continues to be on the weak side. And they are plagued with, of course, all sorts of issues. Is it just that it's lagging? It's a lagging indicator? Or are they not going to really kickstart their spending? We don't know. That's why I put a question mark yet. The third slide really is on China. Markets have run ahead, predicting very strong growth in earnings. Will the growth in earnings justify the rise in the market? Or are we in sort of creating another mini bubble of sorts? Another question which hopefully some of our panelists can answer. My fourth slide, stock returns so far. Price earnings expansion has been a key driver of the stock market. If you look at really 2009, the composition of returns, PE expansion means the PE now is on the high side because markets expect earnings to be very strong. So if you take a stock that is P of 25 times, which is on the high side, if earnings are going to double, the PE drops to 12, then yes, it's certainly worth buying a stock that's P 25 times. But if the earnings do not come in, what will the market do? So the markets certainly are running ahead, expecting quite strong earnings growth. Will it materialize? So far, earnings in many parts of the world have been met by cost cuts, and especially in the developed world, where you see that they are basically cutting headcount, cutting staff, and you see unemployment rising all over the world. This obviously cannot continue. You cannot continue to cut staff. Someone got to run the business. So in this earnings season, all over the world, analysts, I'm sure, would like to look for top-line growth, meaning revenue growth, to confirm that indeed earnings are going to come in. The next slide really is market psychology. This is done by Morgan Stanley, talking about a typical market phase. Obviously, the bear market, which is on your extreme left column. We've been through that last year. It has bottomed, which is sometime in February, March. Was there value? Yes, there was value, and people were buying investment style. People who picked up value stocks have done very well. And now we are moving perhaps into a growth. Is this, this is a typical sort of cycle. Will this cycle be the same as a typical cycle? Meaning that now earnings are going to kick in, markets have run ahead, and now the earnings kicking in will justify the markets continue to rise. Analysts are behind the curve. They will continue to re-rate earnings up, and we are into this virtuous cycle. Are we there? Or is it different? I don't know. I pose that to my panelists of participants. Another sort of macro thought. In the aftermath of a big bear market, again, this is Morgan Stanley research, typically there's a huge rebound. Bear market, okay, the months are not, I guess, that relevant. I think the shape perhaps is a little bit more important, but these are the averages of many, many bear markets. Coming off by 56%, the rebound rally will recover 70%, and then after that it's sort of range bound, and the range bound is huge. The range bound can be, 40-50% for a couple of years. Are we going to experience this? Are we actually in this rebound rally? Are we? Or as actually we are now moving into a secular bull market, which is breaking away from this, and everything is okay. You can dip your toes, all 10 toes, into the water once again and start swimming. Again, something to pose to the panel of participants. And lastly, really, we are in a strange environment at the moment. We have had just one of the worst crises since the Great Depression, okay, which is in 1929. And is the recovery going to be a normal recovery? Or could it be different this time? Governments all over the world have acted, and interest rates are at an all-time low. Governments all over the world are spending money in terms of fiscal spending to buffer this downturn, to avoid the second Great Depression. They have been successful. But what is really the cost? Financial markets have lifted off because of all the money flowing around today. But the money and really all the fiscal spending is directed at the real economy, the real sector. And the real sector today, of course we can play with statistics depending on year-on-year, month-on-month comparison. The real economy, which is on your left, is sinking less. Okay, it's not above water yet, but it's sinking less. The disconnect, so there's a disconnect and there's a time lag at the moment. Now, is it just a time lag? Meaning that the chap on the left actually will come up and start breathing. Okay, so is it a disconnect? Will the wealth effect, which all of you have participated in this market, I'm sure, will the wealth effect, the money you've made, spill over into real economy? And there's a case to be made for that. Or will it not matter? And we'll just all end up like Japan anyway. I don't know.